In this week's Property Insider Chat, Dr. Andrew Wilson and I discuss a number of factors that are going to affect what's going to happen to inflation and I guess in turn interest rates. We talk a bit about the price of oil, what's happening with house building costs and rentals. We also have a look at what's happened to regional markets around Australia, and in general they've performed similar to their neighbouring capital cities, but often much better. We also discuss the auction clearance results, so if you want to keep up to date with what's happening in our housing markets, please subscribe to this YouTube channel and click the little bell icon so we can keep you updated each time a new show comes out. Have you wondered what's really going on with inflation, where interest rates are heading next? In today's Property Insider Chat, I plan to ask Dr. Andrew Wilson, Chief Economist of My Housing Markets, to unpack some of the forces driving inflation and interest rates, when these are two critical factors that ripple through every aspect of our financial lives, particularly if we are worried about our homes or property investments. Hi, Andrew.
Yeah, good day, Michael. And it's interesting, I guess, in the middle of the month, just to look at how some of the key drivers of inflation are tracking. It gives us a sense of the outlook, particularly for interest rates. Although I think the Reserve Bank are just a little bit of a law unto themselves at the moment in terms of their settings. But nonetheless, I think it's important that we look at the trends for some of those key drivers, just to see what the outlook will be. Of course, the next real data set is the March quarter inflation data, which doesn't come out till the beginning of May. Of course, that precedes the next Reserve Bank meeting without discussing what will happen, because we don't know what's going to happen between now and then in terms of the data. I still think it's a bit of a long shot that we'll get another interest rate cut, but with this Reserve Bank, you never know.
Well, there's lots of things happening, not just locally, but overseas that are affecting inflation. So often we think about local factors, but there's more than that, isn't there?
Well, there is, but I think it's interesting when we sort of look at the local environment or the international environment. Of course, the American government is embarked upon a mission of raising tariffs for a lot of the goods that it imports. Of course, that's got a lot of news. They've raised tariffs for our exports of, so Australia hasn't been immune. Our tariffs of aluminium and steel have been affected, but it's only a very small amount that we export to the US. So it's not really going to affect us per se. And we have a trade surplus with the US. In other words, a deficit. In other words, we buy more from the US than we sell. So they'd be happy with that. And but nonetheless, I think it's interesting that Australia has said that it's not going to retaliate by putting tariffs on American imports, even though I saw an ex-Labor luminary, Mr. Shorten, was getting his 2 bobs worth of media attention, making the nonsensical, clickbait, proposal that we should be retaliating. We haven't. I think there's no sense in retaliation. I mean, I don't understand what retaliation is anyway, how it offsets the tariff, imposts. And I think it's interesting that both Australia and the United Kingdom have decided not to retaliate against these tariffs. And I think that's, I don't think it's just wise diplomatically, but I think it's actually a wise economic move, because I'm yet to see any sense of why you could justify, a sort of retaliating in this environment of higher tariffs, particularly when we're only being affected at the margin. So I think,
as they extend the tariffs, Andrew, and there's even a hint that maybe they will be putting tariffs on imports of beef, and that could affect us a little bit more. But these are all just suppositions at this point.
Well, that's right. And as I said, all the talk of retaliation is just, part of the sad media frenzy that we have to put up with these days. And it's sort of mano a mano gladiatorial contests. You're going to put a tariff on our imports, will put a tariff on our exports to you. So, but as I said, I'm not sure it has any economic advantage other than acting as some sort of a disincentive. But the big picture is America has nearly 350 million consumers. That is a very big base for any exporter to target. There's no market that comes close to that, particularly in terms of finished goods. So it's not an environment which is even in any sense, because America will always have the whip hand in terms of its demand center, all those
Yes.
consumers. So, and that's something an exporter would be very wary of, if that demand center was turned off in any way, so you've got to be careful of what you do. And as I said, I think it's interesting that both Australia and Great Britain are treading a more circumspect line in this environment, unlike Canada particularly, who's out there looking a little childish, really, in terms of some of the statements that are being made. But of course, they're also being encouraged to get a little hot under the collar by the talk about turning Canada into an American state. So it's all very interesting, isn't it?
Isn't it? Well, you regularly suggest that our inflation tracks international oil prices.
Yes.
We tend to think about local things like rent and the cost of food and power, but there's other factors as well.
Well, that's right, Michael. And the fall in, the very high prices of oil during COVID has certainly been a key factor in pulling inflation down and allowing us some relief from interest rates. Now, it's not the complete story in terms of what drives inflation, but when we look at some of the charts that compare the movement in the price of oil, the international price of oil, and the changes in our inflation rate, you can quite clearly see the relationship there. It's not absolute relationship, but certainly as the price of oil has fallen, so has the inflation rate, and almost in line. And some of the good news lately has been certainly that the price of oil is continuing to fall after a revival. When we look at the changes on a month-by-month basis over the year, so if we look at the latest data is February this year, comparing it to February last year, we can see actually the international price of oil is tracking 7.3% lower than where it was a year ago. So this is always going to offer some relief in terms of our inflation rate. But the price of oil had actually started to rise, not rise absolutely, but rise in relation to where it was a year ago, Michael, over the past 6 months. But now it's certainly heading lower. And when we look at the actual price of oil, it's now, latest data shows that we're in the mid-60s, and that's half of what it was at its peak back in the beginning of 2022 during the COVID issues. So it's certainly significant relief there in terms of the price of oil, and the talk is that will continue. So that's good news going forward for the outlook for inflation. Price of oil is clearly continuing to fall, but I guess we've got to make the point that it's a mug's game to predict where oil is going, because it does tend to be a volatile commodity. But certainly the trends are positive over the last 4 or 5 months in terms of downward movement in the price of oil. So on that basis, we can say that that's going to have offer more relief from inflation and prospect of lower rates.
That's good news. Again, looking closer to home, one of the big imposts in inflation over the last couple of years has been home building costs. We know that's had a spin-on effect on lots of areas of our housing market. How's that tracking at the moment, Andrew?
Well, obviously fuel costs are an important driver of inflation, Michael, not just at the bowser, but also, the costs to transport goods and goods. Works its way through the food chain, which can put upward pressure on prices if oil's rising. But the other significant factor is housing costs. And in Australia, we measure housing costs in two principal ways. First is rents, not asking rents, but actual rents. So we track asking rents here at My Housing Market. And it does take some time for changes in asking rents to work their way through to the total rental market, which is quite understandable because people have leases, and those leases adjust slowly to market forces, or can adjust slowly to market forces. But the other factor that is important is house building costs, Michael. Not apartment building costs, but just house building costs. So they're the components, the main components for housing costs. There's also electricity costs, but we won't talk about that today, or energy costs. But we did have an outbreak in building costs, house building costs, due to the previous government's home builder policy. Of course, they released a lot of demand for new housing with their incentives for potential buyers of new housing back in 2022 as a COVID initiative to stimulate the economy. We had too much demand, not enough supply, shortage of tradespeople and building materials. That led to an absolute breakout in house building costs. But we have seen that starting to ease. When we look at, we run an index of house building costs at My Housing Market. Firstly, the good news is that over the month of January, the house building cost index was steady. You can see on the chart there how it's changed from what was a massive rise from 2021 with that into 2022 and 23 as a result of that stimulus package for housing. But now starting to level off, a little bit of an uptick over recent months, but now leveling off over January. But the interesting thing is when we look at the index in terms of its growth rates over the year, we can see that, as I said, after a couple of months of increased house building costs, we're now starting to see, or over the year to January, we've seen a decline back to 3.5%, which is, still high in a relative sense when we look at the historical nature of house building costs, but certainly good news in terms of a downward movement in our house building costs. And the Reserve Bank did mention that it had been tracking, and through the ABS mentioned that they'd been tracking lower house building costs. So that validates their position in terms of house building costs. So some good news on oil and some better news on house building costs, Michael. So, going forward, of course, we've got a couple of months to go of data before we get to that May decision. But early days, we're looking at trends being quite positive, at least to justify the Reserve Bank's position or decision to cut rates last month. Now, I mentioned rentals, and we do have that environment in rentals, and that's whereby asking rents are not what the ABS measure in terms of its house building costs for inflation. They measure the total rent market. But we have an index here which measures the quarterly change in total capital city rents, Michael. So this takes it on every day. We measure the past 90 days of rents. So we take an average rent for capital cities, combining both houses and units. We turn that into an index. Now, as we discussed last week with the rent report, we're now starting to see, I think, what is quite a significant retightening of our rental markets. We're not seeing any short-term breakout in rents, but when we look at the trends, we can certainly see that there was some relief according to this index over the latter part of 2024, when we did see an easing in demand for rental properties, and rents did ease when we compared them on that 90-day, day-by-day basis. But just recently, we're starting to see an uptick, which sort of runs in line with those tightening of vacancy rates that we revealed over February, Michael. So just a sign there of a bit of a recovery in rents. So not so good news for rents as a component of the housing costs that the ABS runs. But just a sense that recent break upwards, which was a revival after the fall, as I mentioned, at the end of last year, may be tapering off. But again, it just adds to, I guess, the variety of indicators we have in terms of the outlook for inflation. But just some signs there that rents, and it sort of validates what we saw in terms of vacancy rates, just might be pushing some upward pressure on rents. And these are capital city rents, and these are asking rents. So it does take some time for it to work into the full model of the ABS that captures all the rental activity in Australia, not just the capital city asking rents.
Well, the Australian Bureau of Statistics looks at a whole basket of goods, and they change them slightly over time when they're looking at what's happening with inflation. Interestingly, they don't take into account house prices, and you regularly report those. But maybe today we could just look at a different set of house prices. We always talk about the capital cities. What's happening in regional Australia, Andrew?
Well, I thought we'd just do a quick update on what's happening in the major local government areas of each of the states, Michael. I think it's interesting when we look at New South Wales to start with. The top performer there is the Tweed. It's actually had a growth rate of 16.9% over the year to February. Median there just over 1.1 million. And of course, the Tweed is adjacent to the Gold Coast. And the Gold Coast has been a very strong market over the past couple of years. I think it's interesting when we do look at all the major LGAs, local government areas in New South Wales, mostly they're all recording growth, starting to ease a little bit at some of the growth levels, but it does reflect what we see in Sydney. And it is interesting to see that local government area activity in a state does tend to reflect what happens in the capital city markets, Michael. So there does seem to be quite a robust relationship there, but certainly the Tweed on top, Albury, which is a budget market in terms of its comparative prices, was also a big mover. Newcastle, of course, which is a regional market in close proximity to Sydney. Sydney's, it's the second biggest region in New South Wales. It's also had a plus 10% growth rate over the past year. And Wagga Wagga, again, a value market similar to Albury, has had 7% growth over the past year. The other market growth has been starting to ease. It's what we've seen in Sydney, Michael, so it is starting to work its way through. But latest news, as we've sort of indicated, is that Sydney market is on a second wind at the moment, certainly, which we'll discuss shortly in terms of auction results. The Sydney market doing very well recently. And we are tracking, some very solid price growth out of Sydney. So it wouldn't surprise to see that likely to translate, particularly into some of those regions that are in close proximity to Sydney. In Victoria, different story, reflects what we've seen in Melbourne. The Macedon Range is top performer. The Macedon Ranges does tend to be a market where you can get some higher priced properties coming in on a periodical basis, and that can push the median up, and of course the growth rates up, because the Macedon Ranges does have some significant areas of prestige property, but up by 25.3%. But as I said, can be volatile according to the price mix coming through. But all the other LGAs in Victoria have recorded negative growth, with Bendigo the best performer, just down by 0.2% over the past year. So
I find that interesting, Andrew. All those areas that people moved out of Melbourne when we were locked down with COVID had significant growth. Ballarats and Geelongs, which are Bendigo, Shepparton, which are quite good regional centres, but now they're suffering even more than Greater Melbourne.
Yes, and affordable areas are doing best, and I think, again, this reflects the Melbourne experience, Michael, that the bottom performers are the Surf Coast and the Mornington Peninsula, which, of course, are prestige markets. Yes. And this is what we see in Melbourne. The prestige markets have been the underperformers, although there was some better news there. The Inner East actually was the strongest performer in Melbourne on the weekend, in the rebound from the public holiday weekend, the previous weekend. So maybe some early signs there that prestige markets are starting to find buyers again. But I do think it's interesting that the prestige regions, Surf Coast and Peninsula, are also reflecting the sort of negative energy that we're seeing in Melbourne City itself. So in Queensland, a whole different story. Look at the growth rates in Queensland. This just, it's what we see in the Brisbane market, which has been very strong. But Mackay's now picked up the mantle in terms of top performer. Value markets, those northern capitals, those northern LGAs. We've seen Townsville being on top of the pops there for the last year or so. It's had a real breakout after a number of years of very subdued activity in Townsville. It's now picking up, and Mackay also, which has been a bit of an underperformer, now the top performer over the past year. Similarly, Rockhampton, they're all adjacent. Cairns up 17.6%, Fraser Coast up 14.8%. And they're now outperforming the LGAs that are closer to Brisbane. And we know the Brisbane market, you can't keep up those boom time results year in, year out. But still some good growth there adjacent to Brisbane. Toowoomba up 14.5%, Sunshine Coast up 11.1%. Gold Coast still rising by 9.4% over the year. And Noosa, the underperformer, up by just 0.8%. But I suppose all the surge in Noosa demand, which we saw through COVID, is just starting to taper off. But when we look at the 2-year results, it's the Gold Coast, Noosa, Sunshine Coast and Brisbane that have been the top performers. It's very hard to keep those growth rates going. But certainly when we look at the Queensland market generally, it's a massive growth rates compared to the other states. And it just reflects, again, that energy that's come out of the Brisbane market. In Tasmania, Launceston...
Before we move on to Tasmania, Andrew, I'd also suggest that some of the Brisbane energy is coming from investors who've been chasing the cheaper markets. I know there's a number of big buyers agencies who are putting all their clients into places like Townsville, Rockhampton, Mackay, and when there's a whole group of new people buying with little stock available, it creates an artificial environment where locals are wondering, what's happened to house prices? How come my house has gone up 30% this year when the local economic fundamentals don't really support that, Andrew?
Yeah, and that's because yields have been pushing up to 8 or 9%, Michael, and that's a great environment for investors. They move in. As you said, shortage of property only puts upward pressure on prices, and that starts to push the yields down. But it's a very solid area for investors, and that's creating this high demand. It's after a number of years in those northern LGAs of underperformance, with the exception of Cairns. But it is interesting that Queensland energy reflects overall what we've seen in Brisbane over the last 2 or 3 years. And in Tasmania,
Hobart was the darling of the investors a number of years ago and had a really good long run. But the Hobart market has maybe at the time just went a bit above its fundamentals, like I'm suggesting maybe Townsville, Mackay, Rockhampton are today. And it's had a rough time over the last year or two, hasn't it?
Yes, and that typically matches Launceston, but Launceston's moved ahead. They sort of go one's higher and one's lower from period to period, and it's Launceston's turn at the moment to be the top performer, with growth up by 5.6% over the year. A little bit of a revival in the Northern Territory. Palmerston's been a positive performer really throughout the past year or so, not by a lot, but it's certainly picking up now, with median house prices in Palmerston up by 9.8%. But what we're seeing now is Darwin's actually started to pick up, Michael. So maybe some early signs of a revival in that Darwin market, which has been, this is the Darwin LGA, local government area, which has been a clear underperformer for a number of years on a capital city basis. But but Palmerston on top as usual, but some better signs there for Darwin. So some interesting results there from our regional markets. And as I said, I think it's instructive to show that those regional markets do follow what's happening in the capital cities.
I just wanted to remind you that this is not specific investment advice, because we don't know your personal circumstances, but we're more than happy to have a chat to help you take advantage of the opportunities the current property markets are offering. So why not have an obligation-free chat with one of the wealth strategists at Metropole to discuss your goals, your options, and what you could do. We're much more than just another buyer's agent. We help you safely create intergenerational wealth through strategic property and wealth advice. Remember, property investment's a process, not an event, so you can't just go out and buy any property and hope to be successful. In fact, now more than ever, getting the right advice is critical. So if you're looking to invest in property or buy a home, go to metropole.com.au and organise a time for an obligation-free chat. You're going to find that at Metropole we're big enough to tip the scales in your favour, but still small enough to care. And since we don't have any properties to sell, our advice is independent and unbiased. Okay, well, let's look at what happened to the auction markets over the weekend. We know Melbourne took a breather the weekend ago
Yeah.
because of the long weekend we experienced here. Melbourne also had the Grand
Grand
Prix,
Prix.
which was a little bit of a distraction, but still there were more people taking their properties to auction. What happened over the weekend, Andrew?
Well, we're sort of seeing a bit of a tale of two sectors, Michael. Melbourne and Sydney have actually performed quite well this year. And again, they were outstanding performers on the weekend. The smaller capitals were underperformers, and we've sort of seen that trend emerge now. But we saw higher clearance rates and higher listings in both Melbourne and Sydney. Of course, it was predictable to see higher listings in Melbourne, as you mentioned, following the long weekend holiday, Labor Day holiday. The numbers weren't as high as they were same weekend last year, Michael, because of the Grand Prix, offered some distractions. And of course, this is the first time in 5 years that Melbourne has had the Grand Prix at this time of year, the beginning of the year, the beginning of the F1 season. So that had an impact against the same time last year where they didn't run the Grand Prix on that weekend. But as I said, it was interesting that again we saw this trend of Melbourne and Sydney being the top performers, and that's really happened for most of the year. And they're still tracking higher than where they were a year ago, and certainly higher than where they left off at the end of last year, Michael. And as I said, we are starting to track some really noticeable growth in prices in Sydney, particularly house prices, and maybe some early signs of some growth re-emerging in Melbourne. And as I said before, the Inner East was the top performer on the weekend with a good clearance rate from healthy numbers, and maybe that's a precursor to some more buyer activity in that market sector. So Sydney 899 auctions are higher than the week before, clearance rate higher again the week before. And again, similarly, both the clearance rate and listing numbers were higher than the same weekend last year. Melbourne well above the weekend before, but the clearance rate was just under 70% in Melbourne, Michael. Again, higher in terms of the clearance rate compared to the year before. But the numbers were down, and we mentioned that's probably the Grand Prix effect on the rebound after the long weekend. But again, the smaller markets, even though we had higher listing numbers in the smaller markets, their clearance rates, Brisbane 42.2, similar to the weekend before. Adelaide down a little bit, 63.6. And Canberra, after looking quite solid over recent weeks, was down at 45.7%. Some issues clearing those higher listing numbers, I would suggest, in Canberra. But the interesting thing is that even though listing numbers were a little lower in Adelaide and Canberra compared to the same time last year, higher in Brisbane, clearance rates were well below where they were a year ago, Michael, in those smaller capitals. So we're seeing that sort of two-speed market evolve. Melbourne and Sydney doing pretty well. The smaller capitals certainly underperforming by comparison. When we look at the monthly results so far, Sydney still tracking above 70%, Michael, into the mid-70s, where it was over February, and higher than where it was at the beginning of last year. Melbourne's also producing some relatively better results this year compared to where they were at the same time last year and at the end of last year. And Brisbane lower than where it was a year ago, and it's been, as we mentioned, a little softer this year. Adelaide's certainly lower than where it was last year for most of the year, and we've been tracking that in some lower price growth in the Adelaide market. And after looking a little better this year, was a weaker result in Canberra, which has pushed the monthly average down, or the monthly rate down. Still above where it was a year ago, but certainly looking a little weaker compared to the February results. So we'll keep our eye on what happens in Canberra over the next week or so. Of course, you can get the snapshot report on Capital City auction results, weekly auction results, on my LinkedIn channel, Doc Andrew Wilson at LinkedIn, around about 6 o'clock on a Saturday. And Michael publishes the full national report on a Sunday, which includes the regional breakdowns for Sydney and Melbourne and the top 10 sales for each of the capital cities over the week under the hammer. And there's a QR code on the screen just in case you missed out on Michael's national report. So a different week this week, Michael, in terms of what we've discussed.
I think it's giving us an indication of what goes on behind the scenes in the Reserve Bank's discussions, decisions, and they're actually quite long meetings, aren't they? There's usually a couple of days where they sit and deliberate what's going on.
Yeah, that's right. And next week we're going to have the latest labour market data, and of course we've spoken about inflation today, but that's the other main focus for the Reserve Bank on interest rates. Of course, it's the labour market or the economy generally, but particularly the labour market. We saw an uptick in the unemployment rate, the latest unemployment rate over January. Will we see that reinforce itself again? If we did get that, it would add to the case for another interest rate cut. So early days, but we look forward next week, Michael, to discussing what's happening in our labour markets.
Okay, look forward to catching up with you next week. Thank you, Andrew.